Which one is the best dividend stock to buy? Domino's Pizza or Coca-Cola stock? I'm going to answer that question in this video looking across 6 different metrics, starting with the dividend yield. So let's get right into it. Coca-Cola offers a dividend yield of 2.26%, more than double the 1.1% yield of Domino's Pizza. The next thing I wanted to look at, and arguably, in my opinion, it's more important than the dividend yield because it speaks to the sustainability of the dividend and the room for growth of the dividend. If you're a dividend stock investor, you're looking at two things. At least I'm looking at two things. I'm looking at not only the dividend yield, that's important to me, yes, but I'm also looking at the sustainability of that dividend and the potential for that dividend to grow over time. That's what I'm really excited about is the dividend growth, right? Because you could buy a dividend stock today that's paying a dividend per share, let's say, of $1. And if you hold that stock for 10 years, there's a chance that dividend per share might increase to $5 or $7. So you might grow your dividend per share by 5 times or 7 times or 10 times, right? So that's something that gets me excited. So that's what I'm looking for. And this helps me identify that. What I'm looking at here is the earnings per share over the trailing 12 months over the dividend per share over the trailing 12 months. And what I have here is Domino's earnings per share of $12.54. That's up pretty nicely from the less than $8 dividend earnings per share, I'm sorry, in 2018. And that earnings per share growth has allowed Domino's to grow its dividend per share over time, right? Because companies pay dividends out of their earnings, right? That's the only sustainable way to pay dividends. Any other form of dividend payment, such as, let's say, if a company borrows money to pay dividends, that's unsustainable, right? Because eventually it will run out of borrowing capacity. Or if it's paying dividends out of its built up savings, out of its built up cash balances, that's also unsustainable because it will eventually run out of that as well. The only way for sustainable dividends and sustainable dividend growth is by growing the earnings per share. Just like as a household or as an individual, can only spend you can only spend the money that you earn, right? If you spend more money than you earn, that's not sustainable because eventually you're going to run out of your savings and you're going to max out your credit cards, and you're going to either need to decrease your spending or you're going to need to increase your earnings, right? It's not a sustainable way. Okay, so looking at Domino's, I see plenty of room for Domino's to continue growing its dividend per share because it's only roughly 1/3 of its earnings per share. Compare that to Coca-Cola. While its earnings per share has been growing very nicely over the last 4 or 5 years, before less than 80 cents in 2018, all the way up to $2.42 in the most recent trailing 12 months, its dividend per share of $1.76 is still a significant percentage of its overall earnings per share. So Coca-Cola doesn't have very much room to grow its dividend per share unless it can continue growing its earnings per share over the next few years, which I expect Coca-Cola will do. Coca-Cola has a significant market share in away from home channels like movie theaters, restaurants, theme parks, concerts, places like that. And now that consumers are going out more, spending more time and money away from home, that's been really good for Coca-Cola, and I suspect that will persist over the next 6 to 12 quarters as consumers really make up for that lost time that we spent at home during COVID lockdowns. The next metric I want to look at is revenue growth quarterly year over year. And I'd like to see revenue growth for dividend stocks because that's essentially most likely how earnings per share will grow, is by growing sales and then keeping your costs low. That's an easier way to grow earnings rather than cost cutting, because there's only so much costs you can cut before you reach the limit. And so both Coca-Cola and Domino's have been demonstrating nice revenue growth. And like I mentioned earlier, Coca-Cola is catching that tailwind, growing revenue faster than Domino's over the past several quarters as economies have reopened. This is a key point though. For the longer term, I don't expect Coca-Cola to have better revenue growth than Domino's. I think after this pent-up demand is unleashed and consumers get through it, I think it's going to revert back to Domino's experiencing better revenue growth. But for the near term, as long as consumers are still wanting to get out and spend money away from home, Coca-Cola will likely be ahead of Domino's. The next metric I wanted to look at is the operating profit margin over the trailing 12 months. And looking at this metric, some of you might be surprised to see just how incredibly profitable Coca-Cola is. A extremely robust operating margin over 20% for the going back all the way before 2014, and that's been growing nicely, reaching 28% operating profit margin in the trailing 12 months. Domino's not too shabby either, operating profit margin of 16.93% and relatively stable over the last decade or so, fluctuating up and down a little bit. Um, it surprises me how some investors will ignore extremely profitable companies like Coca-Cola and Domino's and shoot for these unprofitable growth stocks with the potential that someday in the distant future they may become profitable, when you've got a company like Coca-Cola and Domino's that's already proven that it can deliver these kinds of profits and these kinds of margins. So this is, I prefer these kind of companies that have proven that they can deliver profits and they can deliver dividends and they can deliver gains for investors. The next thing I wanted to look at is cash flow from operations to sales. And I want to this measures how good a company is in turning sales into cash flow, right? Because accounting can allow a company to show profits where it might not be earning cash flow. One example of that could be that companies are uh, offering better credit terms to their buyers, which makes it easier for them to purchase their products. But then those sales, they may record them as profitable sales to begin with, but 6 months down the road, when it comes time to collect on those accounts receivable, there's a higher percentage of defaults because the company extended credit terms too broadly. So looking at cash flow from operations allows you to see how good a company is at turning cash flows out of sales. And Coca-Cola has done an excellent job with this, expanding it and having a cash flow from operations over 25.62%. Domino's again, uh, far behind Coca-Cola. Coca-Cola makes Domino's look bad, but a cash flow of operations to sales of 10.48% is solid. It's not bad at all. Finally, to answer the question, which one of these two stocks is the best dividend stock to buy, I wanted to look at the valuation, right? Because yes, we noticed that Coca-Cola is outperforming Domino's in several key metrics, but if I saw that Coca-Cola was way more expensive than Domino's stock, I may say to myself, you know what, it's not worth paying that much more for Coca-Cola, even though yes, it's a better stock, but it's priced too high. The premium is too high. It's the same thing as if you go to a car dealership and you have a Mercedes dealership on one side of the street and a Honda dealership on the other side of the street. You, of course, you look at the Mercedes and you say that's a much better car than a Honda. But then you look at the Mercedes priced at $95,000 and the Honda priced at $25,000, and you say to yourself, yeah, the Mercedes is nicer, but it's not $75,000 nicer than the Honda, right? So that's kind of what I do when I look at valuations in stock. I determined, yes, which stock is the better one. We noticed Coca-Cola was better across several metrics, but I wanted to look at valuation. And valuation, Coca-Cola at a forward price to earnings of 22.49 is cheaper than Domino's, trading at a forward price to earnings of 23. So, because Coca-Cola was better on several critical metrics, not all of the metrics, right? The sustainability and the potential for dividend growth I would give in favor of Domino's. But for the most part, the other metrics, Coca-Cola was uh, better, and Coca-Cola has better near-term prospects, whereas Domino's actually lowered their near-term prospects. They lowered their guidance for the next couple of years. So I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So I would say Coca-Cola is the best dividend stock to buy over these two, right? If you're thinking between these two, but they're both excellent dividend stocks to buy. In fact, Domino's was on my list of top 23 dividends, top 23 stocks to buy for 2023. I recently took Domino's off my list. I downgraded Domino's because of what I mentioned earlier when it lowered its long-term, its near-term 2 to 3 year outlook. It lowered that guidance, and that was a bad sign to me. So I took Domino's, I downgraded Domino's off my top stocks to buy list. But if you want more information on my top stocks to buy for 2023, I've recently updated that list, and I'll link it to the video here. So please go ahead and click on that, and I'll see you over there.